Hello everyone, I'm Yali Jiang. Silver just dropped below $28 an ounce while Bitcoin fell under 94,000, and Alphabet dragged the entire market down by more than 2%. What you're watching isn't just another routine correction. What you're watching is three supposedly uncorrelated assets moving in lockstep, and that tells us something critical about the structure underneath this market. When silver, Bitcoin, and tech stocks all fall together, you need to ask what invisible hand is pulling all three strings at once. Before we go further, subscribe right now, because what you're about to hear explains a shift most investors still haven't noticed. This isn't about one bad day. This is about a pattern that's been building for months, and it's finally breaking into the open. Let me walk you through the numbers, because the surface story doesn't explain what's actually happening. Silver opened the week at $29.15. By midday Thursday, it was trading at $27.85. That's a 4.5% decline in less than 4 sessions. Gold dropped too, falling from $29.15 to $28.60 an ounce, but silver fell harder. The gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, widened from 84 to nearly 87. That divergence matters, because historically, when silver underperforms gold during a sell-off, it signals that investors are treating silver like a risk asset, not a safe haven. Now look at what happened in the equity market at exactly the same time. Alphabet reported earnings that missed expectations on cloud revenue growth. The stock fell 8% in a single session. That pulled the NASDAQ down 2.3%, and the S&P shed 1.6%. Tech sold off hard, which makes sense given the earnings miss. But here's where it becomes important. Silver didn't fall because of industrial demand concerns. It didn't fall because of mine supply increases. It fell because liquidity tightened across the entire risk spectrum, and when liquidity tightens, everything that isn't treasury bonds or cash gets sold. Let me explain what that means. When institutional investors need to raise cash quickly, they don't just sell the asset that disappointed them. They sell whatever they can move fast. Silver is highly liquid. Bitcoin is highly liquid. Tech stocks are highly liquid. So when a major position needs unwinding, or when margin calls start coming in, or when a fund needs to meet redemptions, those are the assets that get hit first. You're not seeing fundamental deterioration in silver demand. You're seeing mechanical selling driven by portfolio rebalancing and liquidity withdrawal. Now notice what changed in the weeks leading up to this. The dollar index strengthened from 101 to 104 over the past 3 weeks. That's a 3% move in the currency market, which is significant. A stronger dollar makes dollar-denominated commodities like silver more expensive for foreign buyers, which reduces demand at the margin. But the dollar didn't strengthen because the US economy suddenly became more attractive. It strengthened because European growth data disappointed, and because the European Central Bank signaled it might cut rates faster than the Federal Reserve. That's a relative move, not an absolute one. At the same time, the yield on the 10-year Treasury climbed from 4.1% to 4.4%. Higher yields make non-yielding assets like silver and gold less attractive on a relative basis, because now you can earn a real return just by holding government debt. But here's the part most commentators are missing. That yield increase didn't come from stronger economic growth. It came from sticky inflation data that suggested the Federal Reserve might hold rates higher for longer than the market expected. And if inflation stays elevated, while rates stay high, that's actually a long-term bullish signal for precious metals. Not a bearish one, but markets don't trade the long-term when short-term liquidity is draining. They trade the immediate pressure. Look closely at the ETF flows, because this is where the story gets more complicated. The largest silver ETF, SLV, saw outflows of roughly $42 million over the past 2 weeks. That's institutional money leaving the trade, but at the same time, physical silver demand from retail buyers in the US and Europe remained elevated. Premiums on Silver Eagle coins stayed above $4 per ounce, which is well above the historical average of $2 to $2.50. That disconnect tells you that two different types of investors are doing opposite things. Retail is buying physical metal because they're worried about currency debasement and inflation. Institutions are selling paper silver because they need liquidity and because short-term momentum turned negative. Now look at industrial demand, because that's the factor that separates silver from gold. Silver isn't just a monetary metal, it's a critical industrial input. Solar panel production alone consumed roughly 140 million ounces of silver last year, and that number is growing at more than 10% annually. Electric vehicles use more silver per unit than combustion engine cars. 5G infrastructure uses more silver than 4G. The structural demand story for silver has never been stronger. And yet the price is falling. That tells you the current move is not driven by fundamentals. It's driven by financial flows. But here's where it becomes important to understand the supply side. Global silver mine production has been essentially flat for the past 3 years. There are no major new discoveries coming online. Existing mines are dealing with declining ore grades and rising extraction costs. Meanwhile, Above-ground inventories tracked by the major exchanges have been falling. COMEX silver inventories dropped from roughly 350 million ounces 2 years ago to under 280 million today. That's a 20% decline in available supply sitting in registered vaults. So you have rising industrial demand, flat mine production, and falling inventories. Under normal circumstances, that would push prices higher. But these aren't normal circumstances because financial market stress is overriding the physical fundamentals. Now notice the correlation with Bitcoin, because this is revealing. Bitcoin dropped from 98,000 to 93,000 over the same period that silver fell. These two assets have almost nothing in common from a fundamental perspective. One is a digital token with no intrinsic value. The other is a physical metal with 4,000 years of monetary history and critical industrial applications. And yet they're moving together. Why? Because they're both being treated as speculative risk assets by the same institutional players. When risk appetite declines, both get sold. When liquidity contracts, both get hit. This pattern has appeared before. In March of 2020, when COVID lockdowns triggered a massive liquidity crisis, gold and silver both fell sharply, even though they're supposed to be safe havens. Silver dropped from $17 to $12 in less than 2 weeks. Why? Because funds needed cash, and they sold whatever they could. Then, once the Federal Reserve flooded the system with liquidity, silver rallied from $12 to $30 in less than 5 months. The fundamentals didn't change. The liquidity environment did. What we're seeing now feels similar, but with one critical difference. In 2020, central banks responded immediately with massive stimulus. This time, central banks are constrained. Inflation is still above target. They can't just print unlimited money without risking a complete loss of currency credibility. So the liquidity support that saved markets in 2020 might not be available this time. And if liquidity stays tight while inflation stays elevated, that creates a very unusual environment where both risk assets and safe havens struggle simultaneously. It's a regime that hasn't existed since the 1970s. Let me walk you through what this suggests about inflation, because this is where the real significance lies. If silver is falling while inflation remains above 3%, that tells you the market doesn't believe inflation is structural. The market thinks this is transitory pressure that will fade once the economy slows. But if the market is wrong, if inflation stays elevated because of energy constraints, supply chain fragmentation, and fiscal dominance, then silver is being mispriced right now. Historically, silver has outperformed during periods of sustained inflation. From 1971 to 1980, silver went from $1.50 to $50. That's a 33 times return. It didn't happen in a straight line. It happened in waves with violent corrections in between. But the long-term trend was unmistakable. Now think about currency confidence, because that's the second implication. When tech stocks, Bitcoin and silver all fall together, it suggests investors still trust the dollar and treasury bonds as the ultimate safe haven. But that trust is based on the assumption that the U.S. government can manage its debt without resorting to inflation. The U.S. national debt is now $36 trillion. Interest payments on that debt exceed $1 trillion annually. That's more than the defense budget. At some point, the math stops working unless you inflate the debt away. And when that realization spreads, you'll see a scramble into hard assets. But we're not there yet. Right now, the market still believes in the dollar's stability. The third implication is about investment psychology. When a tech stock disappoints and the entire market sells off, that tells you positioning was crowded and leverage was high. When small triggering events cause large price moves, it means the system is fragile. And in fragile systems, the assets that get sold first are the ones that recover fastest once the pressure eases, because the selling wasn't based on deteriorating fundamentals. It was based on forced liquidation. So what does this mean for silver going forward? In the short term, the path of least resistance is probably lower, because the factors driving this sell-off haven't resolved. The dollar is still strong, yields are still elevated, tech stocks are still under pressure, liquidity is still tight. But in the medium to long term, every fundamental factor that matters for silver is improving. Industrial demand is rising, supply is constrained, central banks are stuck between inflation and recession, fiscal deficits are exploding, and investor positioning in precious metals is still extremely light compared to historical averages. The current price action is creating an opportunity, but only for investors who understand the difference between short-term noise and long-term structure. If you're trading on momentum, silver looks terrible right now. But if you're investing based on supply, demand, and monetary dynamics, silver looks like it's being handed to you at a discount. The question is whether you have the patience and the conviction to act when the price is falling, instead of waiting until it's already recovered. What's happening in the silver market right now matters because it's a window into how financial markets behave under stress. When everything falls together, it tells you the system is more interconnected and more fragile than it appears during calm periods. And it tells you that the assets with the strongest long-term fundamentals are often the ones that get hit hardest during short-term liquidations, because those are the assets that institutions can actually sell. You can't sell a factory. You can't sell an office building quickly, but you can sell silver, Bitcoin, and tech stocks in seconds. So that's what gets sold first. Thanks for watching. Subscribe, share this, and stay alert. Because what's happening in the silver market right now matters more than most people realize.